So what's happened is that the starting point was Greece lied to the capital markets, which is a very, very stupid thing to do. And as a result, they're now paying 10% interest on their 10-year government bonds. What's happened is that the markets have said, no, instead of governments being allowed to stimulate the economy, get back to growth, and then move on and pay down these deficits, we're now scared. So we want to see these countries putting in place austerity packages, at least reducing that annual level of deficit, so that we know that we've got confidence that the country is going to be well run. Now, the problem with that is that these austerity packages being put in are taking growth out of the economy. In fact, to get down from a 6, 7, 8% deficit to a 3% deficit of GDP means you're taking 2, 3, 4% growth out of the economy at a time when we're struggling to really regain any growth. So the real stress that's coming through is, you're reading in the papers, is the euro going to survive? Will we have a strong and weak euro? To be honest, I'll leave that to others to pontificate on. No one really knows. I would say don't underestimate the huge political capital that has been invested in the creation of the euro. That's not to say there isn't a risk that something structural will happen, but there is huge capital behind that. I think what's more important is that the austerity packages that are having to be put in involve government reducing expenditure on contracts, reducing public sector employment, cutting back on benefits, increasing taxes. All of those things have ripple-on effects through the private sector. They are going to have impacts on the type of growth and the type of activity that we see.
Just before we leave this chart too, it's worth pointing out that if Australia was on this chart, it would be roughly where Germany is, perhaps even a little bit closer to the Maastricht number. So they're in good shape by European standards.
Absolutely. I mean, in terms of the impact that's going to have, and we've kind of seen the US equivalent of this already, from an employment point of view, what we're seeing, I mean, we've seen, this is financial and business services employment, and we've seen well over 1 million jobs come out of the core financial and business services markets in Europe. 15 million square feet, roughly, of office space that is no longer occupied. And again, this is a forecast, but what it's showing is that it's going to take us 3, 4, 5 years even to get back to the level of employment that we had at the peak of the market, which crudely means that that's to get back to the level of space that we have available in the market. So, clearly there's going to be a slow recovery here.
Mm-hmm. Yeah, so when we look at the impact on especially capital values now, and we start to turn our minds to the property markets around the world, and this chart shows you the capital value changes over the last decade in each of the regions around the world, and it does actually show you that Asia is already leading the pack, mostly on the back of some yield compression in that region. The Pacific region is stabilising, the US is stabilising. But it's interesting that the European capital values are actually starting to rise already. And against the backdrop of a poor economy and employment outlook, we're starting to see capital values rise. And the other interesting thing too is that global capital flows and the turnover of commercial real estate has actually been the highest in Europe of the other major regions in the first quarter of this year. It's still relatively low, but Europe is certainly seems to be attracting a lot of investor interest despite that difficult picture. So, I mean, it seems to be something of a sort of a dichotomy there, Nick. Mm-hmm. You might want to take us through that and focus on that question a little more.
Okay. Well, I'm certainly not going to pretend that everything that happens in the European real estate is entirely logical, because it isn't always. But I do think that if we start looking at this in a bit more detail, we can sort of understand what it is that's really driving the market at the moment. Let's start with a couple of the things that you picked up on. From a turnover point of view, the 2009 numbers were far lower than 2008. But actually, when you get into that, you see that the low point in the market in terms of the volume of activity was very much the first half of 2009. And since then, we have seen a recovery. We have seen activity starting to come back into the markets. The fourth quarter was particularly strong, unexpectedly strong, and we weren't necessarily expecting that to continue. The second quarter numbers are just coming in now, and they look as though they're going to be roughly the same as in the first quarter. So what we're seeing is some degree of recovery, not back to 2006 and 2007, but it really is time that we stop using that as any kind of benchmark. This was an extraordinary time in the property market, largely fueled by very large amounts of very cheap debt. The activity that we were seeing then isn't normal. So we are gradually heading back towards a slightly more normal level of activity. As you pointed out, capital values are starting to move upwards. Now, very important to bear in mind that we're not saying that there is a wholesale and widespread resurgence in the level of value across the market, but certainly values have more or less stabilised in most markets and sectors. And what we have seen is that at the prime end of the market, we are now seeing capital values moving upwards. So, what is it that's driving that? Well, from a technical point of view, it's pretty straightforward. It's been yield shift. And what we saw was an exceptional response in the market. These are our prime yield indices, and what it shows is that at the worst part of the market, late 2008, early 2009, prime yields were moving out at anything up to 50 basis points a quarter. And these are sort of weighted averages across Europe as a whole. So in some markets, seeing much, much more movement than that. We expected that rate of value decline to slow. We were quite surprised by how quickly it slowed. And we were certainly surprised by how quickly we've gone back into a period where yields are actually compressing again. And we're seeing 20, 25 basis points coming off yields on a quarterly basis.
Are these, Nick, yields which are from transactions or actually an implied or quoted type yield?
Yeah, they're a kind of combination. What we do is each quarter in every market, we identify what we think the prime rent and the prime yield are, and we can then derive from that a sort of synthetic capital value. It's obviously based on what transaction evidence we're seeing in the market, but at times when the market's very thin, it means that we're also picking up actually where we think the top of the market will be trading. So it certainly tracks in terms of the trend and the pattern. It tracks the more detailed transaction and valuation-based indices like something like IPD.
Okay. Let's have a look now at what's been sort of driving the change in capital value in a bit more detail. And I think this chart, Nick, I could talk about this chart for an hour alone. I think there's so much in this. Take us through what's been driving the market.
Absolutely. I mean, we're using the office sector as the example here. What we've done is to split out the movement in capital value. So the total bar is the movement in capital value over the preceding 12 months. So these are annual change figures. The darker bit of the bar is the change in value that's being driven by the movement in rents. And the lighter bit of the bar is the change in value that's being driven by movement in yields. And I think, apart from the fact that clearly this is a very cyclical market, one of the things that really stands out is that the overwhelming colour is dark green. So it's overwhelmingly, it's rents, it's the movement in the occupational markets that tends to drive the movements in value in the market. But what also stands out is that the exception to that has been the last cycle, where it was yield shift rather than rental growth that drove values up during that period, 2003 to 2007. It's then been yield shift that's been responsible for a huge amount of the value decline that we saw through the downturn. And surprisingly, it's actually been yield shift again that has started to push values straight back up again.
Mm-hmm. Yeah. I guess in some ways the most important bar of this chart is the last one and maybe the next one. And given the sentiment that's been changing in Europe recently, how do you think that sentiment's likely to impact on yield going forward?
It has certainly been a very unusual cycle from our point of view. And I think that you picked up on exactly the right word there, which is sentiment. What we've got here is an index called the VIX, the VIX. I won't go into exactly what it is. What it's used for is as a kind of investor fear gauge. This is the dark line running along the bottom. And what it shows is that right the way through late 80s, through the 1990s, and the earlier part of the decade, we had a whole series of events which made investors aware that there was risk in the world. The Russian debt crisis, Asian debt crisis, 9/11, Enron, all sorts of things that made people very nervous and cautious and aware that there was risk. We then went into this very unusual period from the middle of 2003 to late 2007, which has been termed, the great moderation, the perfect calm. And during that period, we had progressively lower awareness and consciousness of risk in the world. The feeling was that things were looking pretty positive. There wasn't a huge amount of risk. Now, what we've set against that is the best kind of sentiment index that we have for the real estate market, which is where yields are. And the lighter green line shows our EU15 prime office yield index.